It's a shame because my name, you can't do that to. Like, you can't go Dustin Timmons. Wow. I should do that. I should just be like Denny Crane. And just throw, whoever knows. And need two. Denny Crane. Or that's three, but yeah. No, can't do it. I'm gonna start doing that. Denny Crane. Denny Crane. Hey, welcome to the Closing Beat, everybody. How are we doing today? I'm Denny Crane. I'll be joining you today. What a great show. It shows how often I watch TV, right? That was like 15 years ago. We are financial advisors here at Jazz Wealth, soon to be open to new clients again. We shut down for a while just to, we built out our whole portal and everything, did a lot of tech stuff in the background because we were getting to that size where, you know, using somebody else's software was like, it doesn't do what we want. It's too complicated. It looks funny. So we spent about the last year building out our own software, and we are about ready to roll. Just didn't want to put new people through that in case, you know, it was confusing or whatever, and then, you know, leave bad reviews, and you know how this all goes. So should be back up and running by next week. If you're interested, you could go to jazzwealth.com and join the wait list. We will have everybody invited by next week, and then we'll just go back to the way we used to do it. If you want to join us, you could do so from the website. If not, that's cool. I'm just happy you're watching here today because we talk about the stock market, and I just like to show that we're advisors that watch the market every day. You know, we look at everything that's going on, love to do it. We're always here. No golf, no cruises, nothing like that. Mike. And so we got a lot to talk about here today. Also, every Thursday we do a class called Wine and Wealth, and sadly, this Thursday I'll have to maybe do a video or something. My wife is going to a conference, and she's very nervous about traveling alone for the first time, having never really been through airports or anything like that. So I'm going to get her off to wherever she's going, Arizona or something. So, you know, when the missus calls, it's like, I gotta do it. Anyways, look off to the right-hand side of your page today. You can see the stock market generally weak. If you follow the markets at all hours of the night, about 4 o'clock last night, market started to give you a little bit of a rally, and it pretty much held until we got to the open, and then it was just choppy mess, which is kind of what the last couple days have been like. And that's typical. It's earnings season for you, so I got some good stuff for you here as we go along. If we look at the charts page, that's, now you know, that's what we call it. We look over here. Let's start with the S&P. So a little bit back and forth. We talked about this last week where we have this middle ground where we've set a low, we set a high, and we're trading right back in the middle of it. So you've got that tug of war between the bulls and the bears. The bulls are winning at the moment, but not very confidently. They haven't really put their stamp on this rally, and rightfully so. You got a lot going on that leads you to believe, should I be buying this? Is this the best price I could possibly get? And so the S&P basically sits right here. The good news is we're down 6% for the year so far, year to date. That's about half of what we were. Down here, we were down about 12%. Now we're only down about 6%. So not too bad there. Half the year's losses have been erased. If you look around the markets here today, largely earnings driven. Check this out. If you look at like something like Microsoft, come on, buddy. Come on, learn how to type. Not much happened today. A little slight gain, not a big deal there. If you look at Apple, not much happened. Earnings are coming, right? So who wants to jump in front of that? Because you look over at Netflix, come on, it's going to be one of those days. And Netflix absolutely just falls apart. So when you look at that, you go, ooh, that's Facebook? Well, PayPal's not been doing too well. Nvidia's weak. Oh my gosh, what? Maybe Apple and Microsoft also fall pretty hard. And so you had a lot of people looking at those bigger, well-known names, even Alphabet I'll throw in there, saying, maybe I'll wait. You know, I don't know. I saw what happened to Netflix. Maybe I'll hold out for a little bit. You got Tesla after hours with earnings coming out, and really good earnings report that you can't really complain about that. We would talk about profit margins, right? Public companies, obviously, that's a big deal. Profit margins. Great for them, despite, you know, not being able to produce as many cars as I'm sure they would like to. We'll come back to that, though. Anyways, looking around, you got Disney a little bit lower on the day as well. That's earnings related. Nobody likes Disney anymore except me. I like the parks, I should say. I have some issues with the management, but I like the parks still. But anyways, as you're looking around, it was the more stable names, once again, that have been doing well. They continue to do well. Verizon's one of those, up 1% on the day. Dollar General, up 260. up on the day, but 260. Procter & Gamble, the stocks that usually you don't talk about because they're just like, what am I investing in? These guys are huge. What are they going to do? And Coca-Cola hitting new highs. Pepsi, Estee Lauder as well, had a decent day. It's got a little bit of work to do. Looking at the REITs around the market here, had a great day. There's some merger news going on there, whether they're the digital REITs or whether they're traditional REITs. Here's like Prologis. These guys are more in the digital space. And new highs, right? So nothing to complain about there if you're in the REIT space. Anything healthcare related also continues its run, and it's not every stock now, but every stock is helping lift. So not every stock is at highs. You could look at the XLV and be very misled about that sector right now, thinking healthcare is the place to be. It's not everybody. You could see the ones I was just showing there. You got Medtronic as well, Abbott as well. They're helping, but these aren't the strongest ones out of the group there. You want to look more towards United Healthcare, the big names in the traditional healthcare space. Cigna would be one of them. You could even do like a CVS, starting to wake up a little bit there. And so that's what's going on there. Over in financials, Visa, another good day. MasterCard, a decent day as well. These are choppy messes right now. American Express coming up with earnings tomorrow, right? American Express. Believe that's tomorrow. Morgan Stanley, good day as well. The bigger banks, not too bad. They're through their earnings season. So all of that's exciting if you're not interested in earnings. I'm going to talk about that here in a second. The worst was the Nasdaq. And you could probably get it, why that's the case by now if you haven't seen the news. Netflix was absolutely crushed today. And big tech, if I use, say, like the XLK, a little bit of a down day, and if I use the SMH, a little bit of a down day. So basically you had people saying, okay, tech, semiconductors, and most importantly, communication services, they're going to be tough areas. I'll go look elsewhere. And so where do you look elsewhere? It's a real easy one, because if you've been following the market for even just the last week, you go, everybody's over at Coca-Cola, Pepsi, Mondelez, Philip Morris, cigarettes, Coke, alcohol, things like that. The stable, boy, if you make gum, you're in a good position right now versus the tech stocks. That's where all the craziness is going on. I'll point out lastly, PayPal. Looking to hit new lows, down 8% on the day, and they have earnings coming up as well. We'll cover that here in just a little bit. Now, we just talked a second ago about Netflix. Absolutely crushed today. Loses 200,000 subscribers. We were expecting them to gain 2.5 million, so a big miss there. And they guided weak as well. Guidance just means they looked forward and said, look, this is bad now. It's going to be bad later as well. They said, we're going to lose 2 million subscribers. Whereas for the rest of the year, we were expecting them to add another 2.5 million, something like that. They want to, quote, re-accelerate viewing and revenue growth now that COVID's given them a clear picture of their pictures, and it's not good. So the stock falls 35% today. Fair warning. I owned it. I had it. It's a position there. It was a huge loss. If you're interested in our office trade segment, you can see how we play defense there so we can start to fight out of this position, because I do not want to own Netflix for the rest of my life. So we went through all of that earlier today to kind of show you the good, the bad, and the ugly. You could actually see the loss. And I give you a hint, it was 5 digits. So if you want to see someone that has a really big losing position in our office trades account, not in our portfolios, come check out what we're doing there. Free for clients as well if you want to join. Anyways, so that's what's going on with Netflix, and I pressed the button early. Don't worry about that one. That one's garbage there. If I messed that up there. Let's talk about this earnings, because that is horrible, right? So if you look at Netflix and go, okay, I get it. The bad quarter, throw in the bath, what do they call it? The bath. Throw in a kitchen sink. Everything's bad. Just say it's bad. CEO, everybody's saying it's bad. Earnings can be really difficult to predict, but there's something called a seasonal earnings reaction. And it's very much like sell in May and go away. That's a seasonal sort of study that people do in the market. Traders like to know about seasonal studies for things like Netflix, because if you're going to trade, you might want to know what's the probability of me doing well or something like that. And investors like to know about seasonality, because if you're holding a stock and historically during a certain time of year or a certain month or whatever it does poorly, you may consider alternatives. You may want to add something else or have a hedge or get out of part of your position or something like that. So let's take a look at something here real quick. We did a quick look at everything. Here is going through every single year, the performance by month that a company reports their earnings. So for example, we're in April right now. You might notice that April ranks as the best month for earnings performance, meaning in this case, the average performance for a stock that reports earnings the next day after reporting earnings, or the day of if they report in the morning, is 0.34%. We said 34 basis points, or otherwise 0.34%. So April ranks as the best. You've got January ranks as second best, February at 0.14 or 0.14. And then if you look towards the later part of the year, even though this is color-coded wrong, it gets tougher. So if you're an earnings trader, you say later in the year, I'm going to have to work for it. If you're an investor that wants to know, should I hold stocks around earnings? Later in the year, you may have to deal with a little bit more push to the downside there. The worst coming in at in September here with about a 0.5% loss on average per stock that reports earnings. And in August, about pretty much the exact opposite of April, really, to the downside. And so what we can see is at the beginning of the year, earnings season, quarter one and quarter two, tend to perform a little bit better with the stock price reaction than the end of the year. Early in the year is fine. Later in the year is a little bit tough there. You could also say the first half of the year is more bullish than the second half of the year, or more stable than the second half of the year. And knowing this is not actually foolproof, it just offers another clue into the seasonality of what you're doing. Remember, I just mentioned a second ago, the sell in May and go away. You know that at least the tide is moving against you, right? You can still invest and trade and do all that stuff, but you know it's going to be a little bit slower going, not necessarily harder. So there's just one way to take a look at it, and I thought I'd share that with you guys here today. All right, hope you like it. Anyways, yuck. That is horrible. That's a bad-looking chart there, so something to take a look at. Now, before we move on to the sectors here for today, the Fed has started changing their comments a little bit, focusing on neutral. So they use that term neutral a lot more, which means they're basically signaling that that's our focus. How fast we get to neutral is really up for debate, but neutral is our target. And for them, neutral means a Fed funds rate of 2.5%. What are we at? 0.75 or something at the moment. So what we're looking at is they want to go from 0.5% to 0.75 up to 2.5%. So they want to raise rates to that point. The question is, how fast do they get it there without damaging the economy, damaging the market there? Going to be really tough because you got mortgage rates. Holy cow, mortgage rates officially hit 5.25%. This hasn't updated yet. 5.25% is going to be right about there. So this is a 10-year chart. You look back 10 years, we have not seen 5.25% 30-year average mortgage rates in 10 years. If I zoom out as far as I can go, it looks a little bit less scary, but you basically could say, if you are 33 years of age or younger, then in your adult life, you have never seen interest rates this high. So any of your kids or you or your family or whatever, if they're 33 or younger, imagine what that does. We're not saying if you're 20 years or younger, you've never seen rates this high. We're saying there are full-blown adults out there that go, well, that's kind of weird, 5.25%. And by the way, we're going to 6%. That's already given if you look at the way the sales of mortgages to the mortgage-backed purchasers. We're going to 6%. It's just on its way. So you now have a point in time where people say, I've never seen 5.25. I just saw 2% or 2.5%, and now I'm staring at 5.25. That dramatically changes the mortgage payment with house prices already elevated there. So really, really tough there. Also, you're already starting to see, yeah, we go. You could see refinances falling off of a cliff there. So people, obviously, mortgage rates going higher. We don't want to refinance at 5.25, right? It's been, 13 years since I've seen any of that. 15 years. So no sense in refinancing. Those are dropping and falling off like a cliff. You see the weakness in the mortgage companies, Rocket Mortgage, for example. Now you know what's going on. 6 weeks in a row that we have fallen there, right? That's almost a record. So gives you a clue in that housing market. If you're thinking about buying a house now, prices are still elevated and rates are extremely elevated relative to their 10, 20-year history. What are you doing, right? Is there a need for that? That makes it a little bit tough. I feel bad if you need to buy a house right now. So that's a tough one. Anyways, let's take a look through some of the sectors. We haven't done this in a while. Currently, sector-wise, communication services is the most oversold and only sector in a downtrend. You can blame that on Disney. You can blame that on Netflix at the moment. That's where it stands. Year to date, it is performing almost as, well, now it is officially the worst performing sector, down about 16%, whereas Tech, I'll use the XLK, down about 14%. So you now have that sector as being the worst if you're looking for those really, big discounts there. Consumer staples, like we've mentioned over the last week here, is the best performing area and almost the best for the year. If it weren't for energy, it would be the best performer, and is literally on fire. Energy happens to be the best performer because of the 40% head start that it got coming out of the beginning of the year and at the end of last year. And so that's where that stands. There are only two other sectors in the S&P right now that are currently in an uptrend, series of higher highs, higher lows. You got utilities as being one of them. We already talked about energy and healthcare. Currently in an uptrend, though not as pretty. So there you go. Stocks above the 50-day moving average. The worst one at the moment is now tech. Oops, there you go. The XLK, less than 50% above the 50-day moving average. And you look at communication services, it's the same thing, less than 50%. The best is energy. Every single stock in the energy sector is above the 50-day moving average, and it ties with utilities being in second place. Why utilities and why staples? What in the world's going on there? Do you ever look at the stock market, pull up your phone or tablet or laptop and go, I'm going to buy me a stock today, right? What about a utility company? What about a consumer staple company? Oh, Colgate sounds cool. Do you ever do that? Nobody does, right? What's the fun in that? Everybody gets up and goes, well, Tesla, right? Well, NVIDIA, AMD, all these exciting things. That's where the excitement's at right now. It's over in utilities, which are historically extremely stable, and at the moment pay the second highest dividend yield in all of the S&P. Energy pays the highest, right? Energy's an obvious one. It's been doing well. But it's the second best performer in dividend yield. It's one of the lowest in terms of volatility with consumer staples there as well. So you go, I don't know about the market. I see Dustin talking all the time. There's no good reason for the market to go higher. Not yet anyways. And so maybe I'll be more stable. Everybody's going that way. So if you're not familiar with consumer staple stocks or utilities, maybe not maybe right now, but maybe that's the thing you should start looking at there. Anyways, new highs and lows for the day. There were 68 new highs on the list. You got Marriott, blast off, blowing away here, just hitting new highs. I actually added it in our office trades as a short position there. We'll cover that as well for you guys. Dollar General is another one, extremely extended. I started a position on that this afternoon. Did I tell you that, Cody? So, yeah, let's just cover that because we're here. They'll be in there, and we show all the office trades and everything, every single nugget of information there. Dollar General sold the 270 calls. Marriott sold the 205 calls just to get something done. Inside of our office trades, by the way, we fought through Netflix, what we could do there. We closed out Fifth Third Bank. That was yours, right? Yes. Cody closed that out. Cody's killing it right now. Progressive, our order did not get filled, but very, very close, actually, to close that for a profit. We closed Applied Materials, Truist Financial, Microchip, and then we added American Express, right? Added American Express and IBM. IBM was the 145 call, and we explained all of that in the office trades, but just in case you missed it, just give you an update there. Where were we? Oh, Dollar General, right? Hitting new highs, and so we want that to move lower. Constellation Brands, I was a day early on that one. We have that one short. That one's extremely extended and did hit new highs today. One Oak, I just thought that was kind of interesting. A little consolidation near what's known as the 20-period moving average. Wasn't doing anything, and then pops, right? Gets a little bit more excitement there. Very diverse company, by the way, if you're not familiar with them. And Devon Energy Company here. Something similar, but not exactly a tight consolidation. It's just one of those at highs. You could really look all over the place. Iron Mountain was a breakout. You could see today at the start of that. There was a lot of good picks on the new high list. Atmos Energy, you're going to find energy in there, a lot of consumer staples or some people say defensive stocks if you're looking those up. As for new lows today, there were only 3, and I've got 2 of them. So Disney down 5%. Actually, this one's not too bad. So this was earnings, caused it to move a little bit lower on the day. And I actually don't mind that move too much. Netflix is the other one. Oh, sorry. Netflix would be the other one. And we already talked about that one. After hours, it's basically flat, slightly higher. And the third one was Etsy. That's right. Etsy just hit new lows, and they've got a little bit till earnings comes out, but a lot of problems there, right? people wanting to, or I believe currently on strike from selling things on Etsy. At least some people are, and talks of maybe forming some kind of weird, but first time ever union that they want to do. I don't think that has any legs, but we'll see what happens there. It's not a lot of good stuff happening with them right now. Amazon, I can do this today. There we go. Amazon, speaking of stocks in the news I didn't mention, Citigroup says Amazon's a buy. They like it right here. I think this is going to be essentially a higher low, and it'll start moving higher from here. IBM was earnings. It's actually really good earnings. It's just my argument is that's probably about it, right? IBM doesn't just take off. It doesn't, like, what's the reason IBM would go to $200, $150, $170? There's no reason there. They did beat on earnings. Revenues came in better than expected. Airbnb, my gosh. This is a really hard stock to be a short-term trader. Not a lot of people talk about it. Got an upgrade at Citigroup. Citigroup was active today in terms of their changes to their analyst ratings there. MarketAxess has earnings. They beat. Revenues were as expected. It was just a good reason for this to come off of lows. A pretty good day. Up 4% for this one. It's extremely oversold at the moment, so that was nice to see. And Lululemon basically laid out a plan. It was a 5-year plan for them to try to take their total sales 100% higher. They want to double their sales. It was basically the 5-year roadmap to how we're going to get there. Nobody really cared. It didn't get any attention. I think on a different day, it probably would have got more attention, but too much to focus on here today. Earnings-wise tomorrow, we've got, a bunch of names here. So United Airlines already reported. Carvana reported as well. You see how CarMax, remember when we covered CarMax, what was going on there? Carvana reported. CarMax was clearly the hint that Carvana was going to do poorly. That was down like 18% last time I looked. Maybe a touch more. So you got American Airlines, AutoNation. You've got Danaher, FCX, Philip Morris. There you go. Tesoro, Union Pacific, which CVX came out with earnings. They did well. The easy thing to look at with the rails is how many car loads of stuff did they have, and what did they get to transport those car loads? What did they make off of that? Well, they had less car loads being pulled behind these trains, but they were able to charge more money for that stuff. So it was actually a good earnings report for them, is the elementary school way to explain it. But anyways, Union Pacific, you would assume now they're going to have something similar. You've got Skechers, if you didn't know, they're a public company. Snapchat and Seagate. Out of all of those that report tomorrow, I believe American Airlines has the best beat rate on earnings. The best performer looks to be a tie between Skechers and Snapchat, meaning being positive more times than being negative after reporting earnings. The worst one is either NVR. NVR is down 5 of the last 8. Is there anybody that's done worse than that? I don't think so. There's some ties in there. Seagate down 5 of the last 8. Philip Morris down 5 of the last 8, but that's not a big mover. And the worst performer out of all of them in terms of earnings beats looks like it's going to be NVR, followed by Skechers. So that's kind of interesting. Skechers usually misses on earnings, or more times than not would miss on earnings, but tends to be a little bit higher. How are they doing, by the way? Skechers is kind of a hot mess at the moment. I will take your questions if I can and see what we can do to answer them. See, Dustin, I said CarMax and Carvana. Dr. Horton, he called it, man. Yep, that's true. I remember we were talking about CarMax, and he said, well, what's up? You think Carvana then, right? And now you have your answer, because that was a bit brutal. They had all kinds of comments about, higher prices, higher inventories, higher lending standards. That's not good for them, right? Higher interest rates, of course, is an issue. It's tough time, right? These guys have lots of inventory. So they're public companies. If you're going to buy a car from CarMax or Carvana, go for it, right? I mean, they're not bad companies, but right now, right this very moment, they have more inventory than they know what to do with. They literally set up a fencing area at the CarMax down the road so that they had a place to put the other cars, because they already filled up their entire parking lot, plus filled up the rows. Like, they have to move cars out of the way if you want to test drive a car that's in a parking spot. And then they set up a fencing area for the rest of them so they knew which ones they were taking in. You think is this the time to pay up for a car? That's a tough one to say because, people need a car when they need a car. But if you're out there shopping for a car because you just feel like changing out your car, that's a problem. That would be a problem in my house. I-bond rates are going up way up in May. Good or bad idea? They do reset twice a year. That one is coming up. If you're interested in those, it's just look at your net yield, right? I get it that on social media, like I get hit with the same stuff you guys do. On social media, the kids and the TikTok people and all that make it seem like this is where you got to go. I could argue that, right? Because what's your net return, right? What happens if you want to close out early? What happens when you got to report that on your taxes? What's your actual net yield? I shouldn't say return. Think about that before you do it. It's an exciting thing. I get it. They've always been there. This is nothing new. It's just, obviously, there's a premium there relative to 10-year averages. John, you still getting the proxy vote emails? If you got one today, send it to me because it should be cut off at the moment, and there'll probably be some stragglers, but I'm supposed to point out anybody that got them today. Let me use it as an example. And other than that, everything should be done. Sorry about that. I don't know who thought that would be a good idea, but just total waste of time and paper and stuff. Just weird. What effect would Netflix drop have on Roku? And surprisingly, not much, right? I briefly looked at it here today. Roku actually held up pretty nice. I mean, 6% for Roku is, it's been a little bit volatile here, but actually not bad. So I wouldn't be scared by that. Hey, Dustin, regarding to Disney, are you pro-bigotry or pro-fascism? I am pro leave the parks alone, right? Bob Iger did a great job making sure the parks were clean, everything was set up there. The new CEO, I just disagree with the changes they're making to the parks. That's where my focus is at. Like, how is my experience when I go there? I feel bad, man. Like, Universal Studios is nice, but it's definitely not as clean and unique as Disney. Now there's no difference. It just, poor management there, right? What they want to do in the state of Florida, what their beliefs are, it doesn't affect me when I go to the parks, man. That's all I care about. I want to go there and get lost in the spirit of what Magic Kingdom is or whatever, when I go to. I don't want to be like, there's gum. There's stuff just thrown on the ground. People aren't, stuff's breaking down all the time. It's just, if you follow what's happened down here at this Magic Kingdom and Disney World location, it just doesn't feel the same, man. Anyways, so in my opinion, I think, I get that Disney's a bigger company than just having this series of parks, but it sounds like bad leadership, man. I-bonds are just another tool in your toolbox. That's a good way to say it, right? It's an option. It's not an all-in option. What I worry about is $10,000 is the limit per person, and I worry that there's a lot of people that watch that TikTok stuff and they say, I have only $10,000. That's perfect. Come on. That's my answer. Come on. What are you doing? Is now the time to buy or sell Alibaba? Well, you got to pick one eventually, don't you? What would you do? I don't know. So for me, I'm not I'm not one that says a stock that's beaten down this much was not attractive until this very moment, and now I want to sell it or short it or do whatever. I don't like that. Right? This doesn't interest me. One little bit of good news, and it has these little spikes like you saw when China eased some of the regulations over there. So I'm not I'm not a seller here. As a buyer, I've still yet to be a buyer. I would like to be. We have like a 0.7% position in it in one of our portfolios, and I'd like to get that back up to 3, but I've been extremely patient on that one. Yep. You're going to take a little bit of profit on Lockheed Martin. Gosh, man. Do we own any? Yes, we do. And I don't know what you're doing or what your time frame is or anything. But if you said, yeah, I bought it at the beginning of the year, I'm up a lot, I want to sell it, I can't blame you for that. I could not blame you. Short on employees still. Yeah, well, and now it's getting political. Though, unfortunately, it's now people will or will not work there based on politics, and that's, come on, you'd put that aside when you go to Disney. You know what I mean? Everybody's welcome at Disney. Just have mad people at Disney. There's fights at Disney now. What are you fighting at Disney for? Anyways, I blame the CEO. Higher mortgage rates are good or bad for mortgage REITs, for example. So there's two ways to, well, obviously there's a lot of ways to look at it, but two ways to look at it depending on where you're going, right? So if you're looking at specifically mortgage REITs that focus on, you got to look into this. If they're focused on like apartment communities, mixed use kind of communities, things like that, you could argue that it's still good for them, right? If you're getting priced out of the home buying market, maybe you rent. I'm also making the assumption you were already renting and you would extend your lease and they don't jack up your rent. Down here, you almost can't live anywhere, but that's one way to look at it. The other way to look at it is if there are specific single-family home or jumbo loan type mortgage servicers, there's still no risk to most of them, right? Because they don't hold the loan. The loan is guaranteed by the government or the others. And so the trouble right now, I have to do a class on this. The trouble right now is the difference between what you would call the risk-free rate of return and the mortgage interest rate. So you got a mortgage interest rate, it's 5%. Let's say that's what it is, right? 5%, but the risk-free rate of return is now 3.5%. We know the 5.5% is not likely going to get refinanced or anything, so those payments are going to be steady over a longer period of time. So now I worry about those companies going, well, we'll hold this mortgage. The risk-free rate, obviously, there's no risk. I'll take the 3.5%, move on to the next mortgage. You worry about mortgage companies holding on to loans more so than they normally would, and then finding maybe some more defaults and issues in there that is not guaranteed. You got 4 of the folios this morning. Oh, if you got an email today, yeah, send it to me. Just one is fine. That's all I need. Why not go to Universal Studios? Yeah, I've been there. That's fine. That's a well-run park. It's not quite as magical as Disney, but yeah, well-run park. I've never had any problems there. What happened to the market within the next few weeks after Netflix dropped so much? Well, Netflix is not the market. Netflix is a large portion of the Nasdaq, so I wouldn't say that. And as you saw today, right, the S&P a little bit weaker, but still posted a positive day. And the Nasdaq was what took all the beating. Now, put that with Disney at the same time, you got 2 big pieces of the Nasdaq that had a bad day. Where do you think Facebook's heading after the upcoming earnings report? I have no idea, because I would have never said on that last report that that's the drop you would have gotten. I would have never said that. So I honestly don't know. I wouldn't mess with it, but that's just not my style. Maybe you guys are more aggressive. That's not my thing. I don't know. Oh, you're welcome. Did you already take new clients? So we're inviting everybody on the wait list. If you're already on there, just because obviously if you've been waiting, it's like, sorry about that. Here you go. But next week we should have it where you can just join. Yeah. Yep. Oh, I'm looking after hours for the S&P. Oh, I'm sorry. Yeah, you're right. S&P down just a touch, basically flat for the day. After hours up a couple points. My bad. I was looking at my chart, not the screen that you guys see. Yep. Well, I think that'll do for today. We'll be back tomorrow to do this for you. And, of course, having different lessons and such all along the way. Appreciate you guys hanging out with us here, and all of you that are interested in joining, I'm obviously thankful for that. We are almost there, so finally getting ready to get back at it. FinTips videos, all that fun stuff again. We now have life that we can focus on now that we've created everything we want to create. So if you're going to join us, that's great. I welcome you and I appreciate that. Otherwise, be back tomorrow. We'll do this all over again. You have a great rest of your day, and see you tomorrow.